Hello and welcome to August's Investor Check-in. I'm James McManus, Chief Investment Officer at Nutmeg. In this month's update, I'm going to be discussing the UK economy, the price of gold, and the attraction of mortgage-backed securities. Well, the UK, like many other nations, is now officially in recession, and data out last week showed that the UK economy has contracted over 20% in the second quarter of the year, the deepest quarterly contraction on record domestically, as this chart most vividly shows, and the largest actually of any major developed market economy in the second quarter. And the falling growth now from the end of 2019 is just over 22%, and that's almost double that seen in the United States and worse than many other European nations. But it is worth noting that there is somewhat of a timing effect in here. The UK was later to lock down than many European nations, and therefore was also later to ease its restrictions. And progress on easing restrictions has also been slower in the UK. So with more of that lockdown taking place in the second quarter of the year, that does affect the comparison. A reversal, in fact, of what we saw in the first quarter, where actually a later lockdown in the UK really helped the UK GDP number. But it's clear the UK economy has been hit particularly hard by the lockdowns. The UK has a higher share of what we call social functions, those that require a close level of human interaction in its economy, relative to many other industrialised nations. And the service sector accounts for around 80% of output, and that was deeply affected by the social distancing measures earlier in the year. However, June's monthly GDP figures really provided room for optimism, as this chart shows. June GDP showing a bounce of nearly 9% month on month as restrictions have eased, albeit from a very low level in May. And so we expect policymakers to remain focused on supporting the economy, on the workers and the businesses within it, to ensure a really robust medium-term recovery in output. Well, gold is an asset that's been attracting a lot of attention of late, but why that is really depends on your viewpoint. And gold is an interesting asset class because to some extent, the beauty is in the eye of the beholder. Different investors have different reasons to hold gold, whether that's a systemic hedge, as a safe haven asset, or as a store of value to stave off inflation risks. But unlike government bonds, gold doesn't offer us a yield, so it pays no regular income. And with interest rates so low, and consequently bond yields towards all-time lows, the opportunity cost of holding gold has decreased. There's very little income to miss out on, if you like. So alongside this, we've also seen real yields fall. That's the government bond yield after taking into account inflation. And they've also moved to all-time lows. In the UK and the US, zero interest rate policy has been enacted, and investors' inflation expectations have begun to normalise post the initial drawdown in the pandemic. And we can observe the long-term inverse relationship between gold and real yields in this chart. And that is when real yields fall, gold has tended to rise, and when real yields rise, gold has tended to fall. So with interest rates expected to be anchored at their current levels for the foreseeable future, for real yields to decline further from here, what we really need is a greater expectation of inflation to come through, as bond yields and interest rates are already very low. And whilst inflation remains a risk, given the extent of the current cost push pressures, not least the huge fiscal spending undertaken by governments globally, higher inflation is by no means a certainty. Labour markets remain a potential short-term drag on inflationary pressure, whilst the level of unemployment remains above that, at any time during the global financial crisis. So systemic risk to one side, with real yields at all-time lows, and gold conversely at all-time highs, we remain cautious on gold. We would like to see greater inflation risks on the horizon. If we did so, gold would remain an interesting asset for our portfolios, but it remains a higher volatility asset than inflation-protected US government bonds, for example. And with the global economy set on a path to recovery, with policymakers taking a whatever it takes stance, we would likely be more inclined to add to equity holdings, actually, if we became more worried about medium-term inflation risk. Well, that's right. We've recently added some small positions in US agency mortgage-backed securities, or MBS, to our medium-risk fully managed portfolios. Now, the first thing to say here is that many people will associate the term mortgage-backed securities with the financial crisis or with movies such as The Big Short, but it's really important to understand that mortgage-backed securities come in many different forms, and agency mortgage-backed securities are actually very different to those referenced in that context. A mortgage-backed security is similar to a bond, and it's made up of bundles of home loans And the mortgage market is actually a really significant part of the US bond market. It accounts for around 25% of the investment grade, the higher rated bond universe in the US. And agency mortgage-backed securities refer to those that are issued and guaranteed by quasi-government agencies in the United States. So they're viewed as very high-quality assets because they share the same credit rating and in some cases, the full faith and backing of the US government. And the mortgages within those securities meet certain high-quality criteria in order to qualify. So why are mortgage-backed securities attractive to us at the current time? Well, as discussed earlier, government bond yields have fallen to all-time lows in recent weeks, reducing their attractiveness from a medium-term risk and reward perspective. In fact, many shorter-term UK government bonds now offer negative yields, and mortgage-backed securities offer a premium, or what's known as a spread, to US Treasuries, and therefore offer a slightly higher yield. Meanwhile, the US central bank has breathed new life into asset purchase programs, including committing to purchases of mortgage-backed securities of up to $40 billion a month. And since the global financial crisis, expanding Federal Reserve purchases has been very supportive of the mortgage market, whilst MBS have tended to outperform shorter-term US government bonds in periods where interest rates are stable or slowly rising. And that's the environment we expect to encounter going forward. So with MBS, mortgage-backed securities offering a higher yield, but similar credit quality and similar volatility to shorter-term US government bonds, and with the Federal Reserve set to continue its support of the mortgage market, we think MBS are an attractive way to seek greater returns in the current environment, despite the wider economic challenges. Thanks for joining us this month. As always, if you have any questions for me or for any of the team, then please do get in contact via email, social media, or leave them in the comments section below. We look forward to seeing you again next month.